Many thanks for joining us. This is Business Incorporated. I am Bisi Adebayo. On today's program, Brent crude trades above $40 per barrel for the first time since March. African Development Bank gives account of its 10-year investments in reducing poverty on the continent, plus business conditions in Saudi Arabia, the UAE and Egypt declined in May at a slower pace than in April, suggesting the worst of the coronavirus downturn may be over. But let's begin with intraday numbers coming from the markets here in Africa, and they're all in the green, with South Africa still taking the lead with a 0.93% jump at about midday. Here in Nigeria, the all-share index was up 0.14% also at intraday. The EGX30 in Egypt had increased by 0.86% as at intraday, while Kenya closed Thursday's session up 0.34%. And in the Middle East, major stock markets also edged up on Wednesday, while shares in Saudi Arabia retreated ahead of an OPEC Plus meeting on output cuts. The Abu Dhabi index gained 0.17%, while in Dubai, the index added 0.77%. Qatar's index gains 1.61%, with market heavyweight industries Qatar rising 2%. The benchmark index in Saudi Arabia, the de facto OPEC leader, eased 0.42%, with petrochemical maker Saudi Basic Industries losing 1.6% and utility firm Saudi Electricity sliding 4.1%. And European stocks are also trading positive today, but U.S. unrest is expected to weigh on investor sentiment. Let's talk to Chelsea Delany for more updates coming from the European space today. Good afternoon, Chelsea. So we're seeing European stocks trading near three-month highs today, and that's as investors continue to focus on the prospects for economic recoveries from coronavirus lockdowns. But could stocks soon be back at their pre-coronavirus levels?
European stocks, surprisingly, aren't that far from where they were trading before coronavirus. So the DAX here in Frankfurt, which you can see behind me, is up again more than 2% today. That's up after it rose about 4% yesterday. It's now only about 10% away from the all-time high that it hit in February. So stocks have clearly been on a really aggressive rebound over the past several weeks. And at this point, it seems pretty unstoppable. Investors, of course, are very much focused on the continued reopening of European economies. So here in Germany, we continue to see more and more steps towards a fully reopened economy. In Italy and France, and really across the entire Eurozone, which today has also announced further easing of restrictions on travel throughout the EU. So there is a lot of steps coming towards normality again, which investors are very happy to see that happening. The data remains quite mixed, though, so the economic picture is not quite it's not quite as rosy as the stock prices are really showing right now. So today we had more data indicating that industrial activity and broader economic activity in Europe does remain quite depressed. It is recovering, but all of the data seems to indicate that it's going to take several months, if not years, for the economy to really recover to where it was before coronavirus.
Now, talking about data now, the unemployment rate in Germany continued to climb in May as coronavirus restrictions hit the labor market. But with the economy continuing to reopen, are people actually getting back to work?
People are certainly getting back to work. The data that we're seeing right now, it shows that unemployment and the number of workers who are on part-time works or who are being furloughed or are seeing their hours reduced, those numbers are still rising in May, but they're rising at a much slower pace. So the unemployment rate did rise in May to 6.1%. And we also did see more workers filing for part-time works, but the number of applications was much, much lower than April. So about 1 million workers filed in May. That's compared to about 8 million in April. So these steps towards businesses reopening, not just in the industrial side of the economy, but also cafes, shops, stores, that is getting people back to work. But of course, as is the case for all of these economic repercussions right now. We just don't know how long it's going to take for demand to recover. So as we've seen, restaurants and stores and hotels, travel reopening, it's still quite unclear when we're going to see a full recovery and full recovery to demand. So even if these are technically open, it doesn't mean that every worker is going to be going back to work full time anytime soon. So it could take much longer for the labor force to get back to where it was before.
Germany's Lufthansa says it will ramp up restructuring plans to cut costs even as it prepares to receive a €9 billion government bailout. Could job cuts be on the way here?
Job cuts are certainly one of the options that Lufthansa is looking at here. They say that they really must, at this point, consider a broader restructuring because they need to be able to pay back this €9 billion that they're going to be getting from the government. And they're also looking at the next few years for the airline industry and just seeing a pretty bleak outlook. So they do expect to start adding more flights over the next several months, but they're saying really through 2023, 2024, they're going to have to be grounding hundreds of planes. They're not really expecting the market to get back up to full speed for the next several years. So that obviously does leave them with more workers than they need right now. They have already mentioned cutting staff at some of their subsidiaries. So their Brussels subsidiary and their Austrian subsidiary, they're targeting headcount reductions from around 20 to 25%. They've also said that other business areas are going to be affected as well, but given the political situation in Germany where the union representation is quite strong for the airline workers, and they're going to be having the German state as their largest shareholder after this bailout, it could be more difficult for them to be cutting back on jobs in Germany. But given the outlook for their business, they say that these job cuts and restructuring charges will really hit the broad swath of their business.
Thank you, Chelsea. Let's now turn to the UK, where Juliana Olayinka is ready to update us about the latest business headlines and market performance this afternoon. Good afternoon, Juliana. It's good to see you. So the latest PMI figures show that the UK's final services PMI reading for May is 29.0. Of course, that's better than the flash estimates of 27.8. But although it's still far below the 50 mark that divides expansion from contraction, what's behind the improvement?
Good afternoon, Bissy. Well, it's certainly a modest improvement. I think the emphasis is on the word modest. I think that can really be put down to the mid-month opening up of the economy. We did start seeing some non-essential businesses open, particularly online. There's also an increase in online sales. But as you mentioned, 50 is the benchmark and a figure of 29 is well below that. The issue that Britain has is that it is a service-based economy. That's where 80% of its GDP comes from. And I believe that this figure really does show that a V-shaped recovery for the economy, or particularly that sector, is pretty unlikely. And that's really down to the social distancing measures. When restaurants and non-essential stores do finally open, they're going to find it pretty difficult to work at capacity if they have to keep people 2 meters apart. There's also a major concern about the government's decision to decide from Monday to ask any passengers coming into the UK to quarantine or self-isolate for 14 days. If that happens, many people won't be coming to the UK. A lot of the hospitality sector does heavily rely on travel and tourism. In fact, we're actually having a briefing here in the United Kingdom in the House of Commons by the Home Secretary, Priti Patel. All eyes will be on that because they're hoping that she may do a U-turn on that, although it is unlikely.
The Bank of England's Governor Andrew Bailey has told banks to step up their plans for a no-deal Brexit. He held a conference call with the UK's biggest lenders yesterday. What would this mean for the banks?
Well, yes, it's Sky News that have been reporting about that phone call. It hasn't yet been confirmed, but we do know that, of course, the Bank of England Governor Andrew Bailey does regularly speak to banks, and banks are already reeling from the possibility of having a lot of bad debt creeping up at the end of the year, as a lot of people have taken out loans. Can they pay them back? Well, that depends on whether their businesses can be up and running. Of course, as well, the banks have also been giving a lot of people a lot of holidays for repayments of mortgages and other loans. So the Bank of England have allegedly asked banks to prepare for the likelihood of a no-deal Brexit. This comes as this week the fourth round of negotiations have taken place between Downing Street and Brussels, and it's not going that great. This month is the last month that the UK can decide whether or not they'll be extending that Brexit transition period at the end of the year. Prime Minister Boris Johnson has put his foot down and said there will be no extension. He also made it into law as soon as he came into power in December. The only issue is, of course, this all happened before the pandemic, and the EU were asking Britain to extend the transition date because, of course, so many countries are looking inward at the moment, and the last thing the EU are focusing on is Brexit. So a no deal does appear to be very high up on the cards, although there is still time. And what we're expecting is that before the end of the month, Prime Minister Boris Johnson will be meeting with the EU Commission Chief, Ursula von der Leyen, to try and thrash out a deal before autumn.
We'll see how that goes. Now, with all of this, tell us, Juliana, how the markets are doing at this time.
Well, the FTSE is doing pretty well. It did well at early trading, taking its cue from Wall Street and Asia. Of course, there is so much civil unrest in the world at the moment, particularly in America. But the markets here in London appear to be turning their back away from that, focus solely on the reopening of the economy. At intraday, the FTSE All Shares up by 1.34%. Up on the FTSE 100 by 1.24%, and it's also the 250 is also up by 1.85%. In currencies, the pound up on the dollar by 0.24%, down on the euro by 0.09%, and up on the Japanese yen by 0.31%. It's worth mentioning, Bissy, that as soon as those PMI figures came in, it actually boosted sterling and also pushed up the FTSE by a couple more points.
Some good news after all, Juliana. Thank you. We'll see you again tomorrow. And stocks in Asia largely rose on Wednesday, with optimism over the reopening of economies as authorities ease coronavirus-induced lockdown measures. Over in South Korea, the Kospi led gains among the region's major markets as it rose 2.87%. Japan's Nikkei 225 also saw decent gains as it advanced 1.29%, finishing its trading day at 22,613.76. The Topix index closed 0.272% higher. In Hong Kong, the Hang Seng index rose 1.22% as at its final hour of trading, while the Shanghai Composite closed fractionally higher at about 2,923.37. Shares in Australia also saw gains, with the S&P ASX 200 up 1.83%. Meantime, the country's Bureau of Statistics says that GDP fell 0.3% in seasonally adjusted terms during the March quarter, falling into its first recession in 29 years. And U.S. stock futures rose in early trading on Wednesday as markets continue to rally on optimism over economies emerging from coronavirus-led shutdowns. Dow futures implied an opening gain of about 180 points, and futures for the S&P 500 and Nasdaq were also up, pointing to a positive start for the two indexes. Let's talk about oil prices now. They're rising sharply, with Brent trading above $40 per barrel for the first time since March. Well, traders are optimistic that major producers will extend production cuts and a recovery from the coronavirus pandemic will spur fuel demand. Earlier on, Brent crude futures touched $40 per barrel before retreating to about $38 per barrel. Of course, U.S. WTI crude futures were up 0.57% at $37.02 a barrel, also rising to their highest since March the 6th. Meantime, Nigeria has joined its other OPEC Plus counterparts in April 2020 to bring into effect the agreement to cut 9.7 million barrels per day that will correct the current situation caused by the COVID-19 pandemic. The Minister of State for Petroleum Resources, Mr. Temipre Silva, who made this known via Twitter, says that based on current data from the NNPC, Nigeria reduced its current production in May 2020 to 1.613 thousand barrels per day. And the minister explains that Nigeria has made concerted efforts to adhere to a commitment and will continue to support. And still to come on the program, African Development Bank gives account of its 10-year investments in reducing poverty on the continent. Please stay with us. Welcome back. The African Development Bank Group says it's delivering on its goals of reducing poverty and fostering inclusive growth on the continent through its 10-year strategy, which it began implementing from 2013. The bank, while reeling out its transformative actions for the continent, adds that millions of Africans have benefited from investments through economic transformation. It states that initiatives such as the COVID-19 Social Bond Landmark General Capital Increase, African Development Fund replenishment, and the Affirmative Finance Action for Women in Africa, amongst others, have helped to reduce poverty and boost economic and social development in the 38 least developed African countries. Meanwhile, President Muhammadu Buhari has pledged the country's support for Dr. Akinwumi Adesina in his bid to get re-elected as president of the AFDB. The president made this declaration on Tuesday while hosting Dr. Adesina on a courtesy visit. The Arab Monetary Fund has extended a new loan facility worth $59 million to Tunisia to strengthen the country's financial position in the wake of the coronavirus pandemic. The Abu Dhabi-based institution says it's been on the development of the Tunisian economy closely and is ready to work with the government to help the country contain the different challenges in the most effective way. The AMF is also considering providing a second loan to the North African country to help with reforms in the banking and finance sector. The pandemic has particularly hit tourism-reliant countries like Tunisia, which have had to close its borders to contain the virus. The North African country's economy is forecast to shrink up to 4.3% this year, and that's the steepest drop since its independence in 1956 due to the coronavirus pandemic. Let's look at business conditions in Saudi Arabia, the UAE, and Egypt. They actually declined in May at a slower pace than in April, suggesting the worst of the coronavirus downturn may be over. According to data from IHS Markets, Saudi Arabia's May PMI was 48.1, a significant rise from April's record low of 44.4, but still contracting as it falls under 50. Slower declines in output, new work, and employment caused the increase. Meanwhile, the UAE's PMI rose to 46.7 in May from 44.1 in April, but sentiment towards future output dipped to the joint lowest on record as businesses voiced concern about the long-term impacts of the coronavirus on the economy. Egypt's PMI rose from a record low of 29.7 in April to 40.7 in May, but still indicates a fall in business conditions and the country's 10th month in a row of falling conditions, and also the second worst recorded after April on record. Meanwhile, South African private sector activity contracted further in May as output and new sales collapsed during the nationwide coronavirus lockdown that began in March. Markets PMI index fell to 32.5 in May from 35.1 in April, its lowest level since the survey began in 2011. All sub-indexes of the survey slumped to their lowest on record, with sharp declines in employment and new orders, in addition to crumbling output due to the lockdown. Business sentiment regarding the 12-month outlook for activity turned negative for the first time in this series. As many countries around the world find ways to live with the coronavirus pandemic, a recycling plant in Tanzania's port city of Dar es Salaam has traded paper for plastic bottles and started making anti-coronavirus face shields. These face shields are being snatched up by hospitals and health centers nationwide as the medical masks are mostly scarce and expensive. Let's see this report.
In a factory in Dar es Salaam, these workers are busy cutting, sticking, and stapling face shields made from plastic bottles. It takes less than 3 minutes to create one shield and costs around $1. Before the pandemic, Zayda recyclers made a profit of approximately $37,000 a month from the collection and processing of paper waste. Its founder, Alan Kimambo, gave up his job at Unilever Tea Tanzania in 2018 to venture into waste paper recycling.
We were supposed to export some of the material very earlier, maybe February or March, but we couldn't do that just due to the lockdown. You know, like our customer in India, India was in lockdown.
Thanks to the manufacture of these plastic face shields, the company has managed to keep all of its 38 employees.
We encountered extra cost whereby some of the critical employees, we are providing them with extra transport so that they would not, come into a contact with, many people, so that at least the operations, would going on smoothly.
Zayda Recyclers has banded together with Tanzania's Recycling Association to create the face shields, which are sold for around $2 each.
The first procedure is to cut the plastic bottles, the bottom part and the upper part. Make sure that you size it into very equal and not sharpen to disturb your face once you put it on. And the second step is to bind the rubber together with the elastic band. After that, you have to make sure that the elastic bands and the rubber are in a quiet positions, not to move or to later on strip off.
So far, we are capable of making more than 1,000 units in a day, and so far we have made more than 6,000 units. Actually, we have made and distributed more than 6,000 units, which is equivalent to 10,000 USD sales in just a space of one month.
Tanzania is starting to ease its lockdown. President John Magufuli announced on May the 17th that he plans to reopen universities and allow the resumption of sports and international flights if the decline in new coronavirus infections continues. Unlike most other African countries, the government has gone for days without publicly releasing their COVID-19 update. There are 509 confirmed cases and 21 deaths, according to WHO data on May the 17th. Meanwhile, Zayda Recyclers continues to receive new orders from hospitals and health centers around the country.
Well, there's more coming from Tanzania, and this time the Energy and Water Utilities Regulatory Authority has released new retail prices for petroleum products in the country, which take effect from Wednesday, June the 6th. The new retail prices released by the regulator shows that cap price for a litre of petrol has decreased by 18.65%. Diesel is down by 16.25%, while a litre of kerosene is set to remain the same. The regulator attributes the fall in the prices to the global trends that has largely affected oil prices at the world market. The authority has advised oil marketing companies to feel free to sell their products at a price that gives them a competitive advantage, provided that such price does not exceed the price cap. Over now to Kenya, where the tourism sector is developing an action plan to ensure that the over $52,000 stimulus package injected into it by the government to jumpstart the industry has an impact. According to Kenya Tourism Federation Chairman Mohamed Hersi, sectors targeted by the fund include hotels, tour guide companies, airlines, and the standard gauge railway. Last week, the president unveiled a $500 billion economic stimulus program to cushion citizens against the financial stress caused by the COVID-19 pandemic. The money will be in the form of soft loans and will be administered by the Tourism Finance Corporation. The country is the third largest travel and tourism economy in Africa after South Africa and Nigeria. And the Aircraft Owners and Pilots Association of Namibia is requesting for a cash injection of $9.5 million for the domestic aviation industry to survive post-COVID-19. According to the association, the industry needs these funds to be disbursed over 24 months, beginning from May 2020. The group says the funds should be disbursed in the form of grants, as aviation operators would not be able to service soft loans even at zero interest due to the industry's high operating costs and low margins. And that's our program today. Thank you for watching. I am BC Adebayo.